Hello everybody, my name's Troy. I'll be leading the webinar. We're going to get started at this time. Before we get going, let's do a quick systems check just to make sure everyone's up and running properly. Just type OK in the chat box if you're hearing me clearly and seeing my screen all right. Hello Davey, welcome. All right, so it looks like we're up and running fine. Thank you for the responses. I have enough to confirm. Obviously, we're covering fundamental news. I think we all know what the obvious driving storyline is at the moment, fundamentally, with the coronavirus pandemic spreading around the world. And so we're going to take a look at some of the latest headlines, breaking stories, and then take a look on the charts and see, technically speaking, what types of entry points you might be looking to find to go in the direction that you think the fundamental news is driving things. As we get going, some things to keep in mind. As always, you should understand that all investments have risk. Trading FX, spread betting, options, CFDs, it's no different. There's definitely risk involved. There's no guarantee of a profit on any one move. But quite obviously, there is a nice potential for profit, which is why we're all here, to learn maybe some ideas and techniques to help us out with the P&L at the end of the day or at the end of the week, each week. And so as we go forward, keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. And if you want to read our full risk disclosure statement, it is found on our website if you wanted to check it out. Okay, so two types of fundamental news. We've covered this, a number of times. We'll just quickly talk about it. Regular economic events, which we'll look at some that came in today. That type of fundamental news, we know exactly what it will be. Maybe PPI numbers, factory production numbers, jobs reports. We know exactly the topic, the time, exactly when the news will come out, and the effect that in terms of the asset it can affect directly. All of that's known in advance, and you can really schedule for those types of economic events with your fundamental analysis. Now, the other type of fundamental news is the extraordinary type of economic events, and that's obviously what's driving the markets right now is extraordinary news. We're dealing with this pandemic that you just don't know when the next breaking story will be about. Maybe the virus is contained better in a certain country, or maybe it's getting worse. Maybe death rate is dropping. Maybe it's going up someplace. And these headlines just keep coming. And we all have witnessed the swings in the markets. Thousands of points in one direction on the Dow Jones, thousands of points back in the other direction. Oil up $10, down $10. The same with other indices around the world. Individual stocks, currencies, etc. So a lot of volatility. So we go into trading right now with that understanding that there is a lot of volatility, and so your trading plan needs to take that into account with both how you figure your trade size for risk management. If usually markets might bounce, I don't know, a certain distance the wrong way before going the right way in normal trading conditions. And so you've figured how far away you like to put your stop loss maybe. In today's market, those bounces and shifts before they get going in the direction that is maybe more sustained are quite large. Okay, so even temporary small time frame movements have become much larger. And so what you want to take into account then is if I'm having to put my stop losses further away to account for these spiky movements before things go the way maybe you believe they'll go, then obviously lowering your trade size can help with the exposure in terms of being able to put your stop loss further away. If you're using a stop loss before you have to give up on the position by taking a smaller trade size, then you can increase the distance to your stop loss without increasing your exposure. Obviously, then that decreases the profit potential, but with the distance and rapidity of the movements on the charts, even smaller size trades have pretty large profit potentials in today's market. So those are just some general ideas about as you're going into moves, to think about your trade sizes. Think about the fact that the movements are magnified with the current trading conditions, and that even smaller size trades could bring nice profits. Okay, with being able to manage the risk side maybe a little bit better as well. Okay, let's go ahead and please ask any questions that you have, give input as we go along. Feel free to interrupt me at any point to ask questions or give input. So as we're looking then at some of the latest news, this is a big one. Prime Minister Boris Johnson tests positive for coronavirus. That probably will drum up some fear through Great Britain and elsewhere. To see someone of such prominent level contract something like this. And so it just makes it feel more real for everybody as they start to see names that they recognize of people like Tom Hanks and leaders of countries and all kinds of famous people catching this virus as well. It can really start to drum up a little more fear and realization of how close this is actually to everybody. So I kind of view this as something that maybe could be negative for the markets a bit when these types of headlines come out. And honestly, I think it's just a matter of time before more and more famous people and leaders, elite athletes, whatever you want to say, more and more we're going to see headlines that, you know, pretty much everybody is able to be catching this thing. And you know, we see in the headlines as well, futures fall. You know, the market has now opened in the US, so we're going to take a look at that. Soon, you know, the time will be moving forward, I think, for most of the rest of the countries here through the weekend. So we'll be back to a slot where next week we'll be having this webinar before the US markets open will start, and they'll open, you know, through the webinar. So in any event, what we're seeing here is the futures were red all day, and it was probably predictable what might happen after the US markets have opened now. So we see the fear, okay? And some positive headlines that could help swing things the other way eventually. We all know there's, or if you didn't know, I'll tell you, there's been a price war with oil, driving the price of oil down as OPEC upped production because they couldn't get Russia to agree to cut production with them. The OPEC nations were willing to cut production to try and counteract the effect of the economic downturn from this coronavirus. And Russia said no, they didn't want to cut production. And so OPEC said, okay, fine, then we'll up our production. And so that really has driven oil prices way down. We'll take a look at that in a little bit. But what do you think might happen to the price of oil, even if only temporarily? What do you think would happen to the price of oil if this headline comes true? Russia's calling for a new OPEC deal to tackle oil demand collapse. So now Russia's realizing, wow, oil prices are so low, we better try and get a deal. Yeah, Dave, I would agree with you. Oil prices, at least in the short term, could take a nice spike up if a deal is reached. Now, this is just speculating that Russia would like to have a new deal. Doesn't mean there is a deal, but that might be enough as well for oil prices to stabilize maybe at the next support level. Okay, if people are saying, oh, well, Russia looks like they might be on board to do a deal to cut production, that could halt just the thought that that is a possibility, could halt maybe some of the drop in oil price. Okay, and if they actually signed a deal, remember that type of unexpected fundamental news that you can't predict when it might break. If a headline broke, hey, Russia and OPEC agree to cut production, you probably could see a rapid spike in oil price. So speculation about it could have an effect. An actual deal certainly would have an effect, even if only in the short term. And the reason I keep saying if only in the short term, because globally, The bigger picture is most experts are expecting large possibility of global recession. So all these short-term momentum builders, like the U.S. having this huge economic stimulus package of over $2 trillion that today the House of Representatives is expected to vote through now. It passed the Senate unanimously, 96 votes to none, with only, I think, 4 senators are in quarantine and couldn't vote because they've contracted the coronavirus. But everyone who voted for it, and now the House of Representatives will be voting today. There's one person grandstanding and kind of holding the thing up temporarily, but I think there's little doubt that the package will pass, and maybe there'll be a little more temporary momentum from the House passing the bill in the U.S. And we may see markets pick up like they did yesterday and the day before. That's what that big rush upward was about. But then the excitement wears when these temporary measures come, whether it's OPEC and Russia, if they reach a deal to cut oil production, or stimulus packages in China and the US and European nations. Most of the large countries are doing this now to try and support their economies, and it creates some momentum, positive momentum in the markets. But the bigger picture is people view things, many investors, bearishly for months to come in terms of recession potential. So high points, many are seeing as opportunities to get back in to short the markets again. And that's what we're seeing actually kind of act out from yesterday through to into today. And I'll show you that on the charts. And so as we look, amazingly, the US economy was doing so well before this virus problem. The numbers are still coming in above expectation. Price index rose more than expected out of the US. This is just today reported. Personal income increased not 0.4%, but 0.6%. Hardeep, let me just check if anyone else is having an issue. Type OK if you're hearing me clearly, or if my voice is not audible, let me know. Okay, I've got enough responses. Hardeep, it's just you, okay? So check your speakers, check your connection. You're having some kind of issue on your side. Okay, so my point here is, the U.S. economy still the underlying foundation is strong. We saw the last NFP numbers were through the roof. Okay, even after a few weeks of this virus scare, because the numbers were from the prior month. And the same thing here, these numbers maybe the next time they come in will be deflated because of the economy being shut down for a while. But you see signs that the US economy still has strength in it, even though yesterday we saw like 3.5 million people signed up for unemployment, which is just a ridiculously large number all at once. But everyone understands it's a temporary thing because people were told not to go to work. So the market still went flying up, even with that number of people signing up for unemployment with that stimulus package. Okay, so that's kind of the landscape right now. We talked about this headline. The relief bill heads to the House of Representatives today. They'll do their little political talks, and then eventually they'll all, or most of them will get on board with that. That's what's expected. With the volatility that's occurring, it's a good time for me to show you. If you go to our main website, you go to trading platforms and click on AvaTrade Go. That is our mobile app that has a special feature on it called Ava Protect. So download AvaTrade Go onto your mobile devices. You can log into your MT4, MT5 accounts using that. And the feature on it that I'm alluding to is Ava Protect. Okay, so Ava Protect is a feature that allows you to protect your trades, and it's under trading info here. Ava Protect. It's a feature only available on the AvaGo mobile app that allows you to protect your trades against losses for a small premium cost. So this is just an example. If I was setting up Euro USD, I pick my trade size, I pick the length of coverage that I want for the protection, and it gives me a price, and that's moving with the market. More volatility on that asset, the price might go up a little. Less volatility, it goes down. Extend it from 1 day to 2 days or 3 days, the price might go up a little. Shorten it to only a number of hours for covered time period, the price may go down. And so if you set this up, and it's available on gold, silver, and most all the FX pairings, if you expect a lot of volatility and you take a look and you say, wow, gold could go $100 in either direction today, maybe you have a feeling, okay, maybe gold will go up $100 in the next couple days. And you look at the premium cost to cover yourself for 2 days. Let's say you were thinking buy, and you look for the premium cost, and the premium cost is a fraction of the amount that you think the potential profit could be, and maybe a lower cost than what you would have done with your stop loss, then it makes sense to take the protection. And now it actually functions better than a stop loss because it could go way down the wrong way. You're covered no matter how much loss during that time period occurs. And with a stop loss, you'd have gotten out and taken your loss. With this, you can wait it out for the whole time period. And maybe it comes flying back up the right way and you profit. We've all had that happen, I think, where your stop loss gets hit, then it goes the right way, and you take the loss and you miss the good movement. This allows you for the covered time period to just be patient. Not going to lose anything more because it goes past where you would have put your stop loss. The protection covers you. Whatever negative floating you have, if there's a negative, when the coverage period ends, gets added back to your account, and the trade keeps running. Or you can manually close it. Let's say in this example, gold was dropping to a support level and you were buying on it, and you say, okay, now I think for sure it'll go up. You don't have to wait until the end of the coverage period to collect the payment on the negative. You can take advantage of the coverage by manually closing the trade early. Whatever negative was there would be added to your account, and then you could reopen just above this support line in this fictitious example. So it's a nice feature. I don't think it's right for all circumstances, but I think when there's a lot of volatility, it's a nice option. If you know there's a big announcement coming up that involves a certain asset, I think it's nice. You can try and trade in the way you think it'll go. You're covered in case it goes the wrong way for a small premium cost. So it's a nice feature. You can even watch a video on this page that tells you all about it down here near the bottom of the page. Okay, so check it out. Everyone should get the AvaTrade Go mobile app if you haven't checked it out, because it has other nice features as well, not just that. Yeah, Dave, one for the time period that the protection is there, there's no need for a stop loss. What you'd want to do though is, let's say you let it keep running and it's in the negative when the coverage period ends, or in the positive for that matter. When the coverage period ends, you'd want to then add some other risk management on. You could either put your stop loss, put a hedge trade, however you would normally handle your risk management. Just be aware of when that coverage period is ending as to what you want to do. Okay, and it doesn't matter if you weren't monitoring things and the coverage period ended and you were in the negative. That negative's automatically added to your account, but that trade is still running. You have to manually close that trade or manage it if you're keeping it open. Okay, good question. So you would probably add the stop loss on if you wanted to use one after or near the end of the coverage period. Okay, so let's get to the charts then. We understand which way the wind is blowing, so to speak. We'll check out my demo account here. You guys are free to be on your live accounts if you're wanting to kind of play along with some of these ideas. Again, though, if you're placing any trades, it should only be because you understand what you're seeing and it's what you believe will happen, not because I think one thing or another. This is not meant to be me telling anyone what trades to take, but certainly the information could help you decide what you want to do. And that's just regulatory rules that I can't tell you, hey, buy off this support level or sell off of this resistance level or whatever the case may be. Okay, so we see oil plummeting. Why is it plummeting? Couple reasons. The coronavirus, obviously, with people thinking there's a big picture global recession may be coming or already started in some people's opinions. And then, you know, the price war still with Saudi Arabia and Russia, and it's just not solved yet. Even with that headline that came out that, hey, Russia is maybe hinting that they want to do a deal now, it didn't stop the dropping like immediately. And we kind of talked about that just because Russia's saying, hey, they want to negotiate, there's no deal in place yet. Those spigots are still open and the oil's flowing out at a faster rate than the world is using it. So oversupply, ever growing, larger oversupply of oil, not good. And then not good for oil prices if you're wanting them to be higher. Yeah, we have MetaTrader 4, MetaTrader 5, both. Yeah, Dave, you might be thinking about a pending order here. I kind of have some ideas as well, especially with the fundamental news we looked at. So let's talk about a couple ideas for oil. And by the way, the stimulus deal that the U.S. is about to pass through the House of Representatives, the Democrats didn't like the idea that Trump wanted to stockpile the U.S. petroleum reserves. Trump wanted to fill up to capacity at these low oil prices. Trump was going to use government money to buy millions and millions of barrels of oil to add to the strategic petroleum reserve in the U.S. to refill it all the way to capacity. And the Democrats put in that bill and said they wouldn't pass it, that the U.S. is not allowed to spend any money right now from the budget on increasing the stockpile of oil in the petroleum reserve. So right away, when that was learned that that's in this stimulus package, that the U.S. won't buy up a bunch of oil right now at low price, that triggered even more dropping in oil price. Because obviously, if the U.S. was going to buy up a bunch of oil at a low price, that helps get rid of some of the oversupply, and the price could come up a little. And it was climbing with the news back here that the U.S. was going to increase their petroleum reserves by buying up a bunch of oil. And then when that deal came out, oil had another reason to drop as well. So that's part of what's driving oil down also. So it's like the perfect storm on oil right now, with a global recession fears, global pandemic, and this part of the stimulus package preventing the U.S. government from buying up oil as well. So we see, let's go to 4-hour candles. I think we'll see it better. Here's the current support level on oil. Okay, fundamentally, we understand why oil's dropping, right? Easy to understand. Once oil reached a resistance level, it was an easy move. Fundamentally speaking, let's go to 1-hour candles again. You should have known that as oil came up, resistance, resistance, resistance. Okay, this was an easy move to sell off of the resistance once it formed, going with the global fears of recession that have not gone away, even with the stimulus deal yesterday and the day before. Talk about that stimulus deal in the U.S. driving oil prices up. It formed resistance, and as the bad news started to come in again, it was an easy move to trade down off the resistance. And your stop loss, you wouldn't have had to risk much. Just, right above the resistance, you put your stop loss, and you see the clear drop from the resistance. Okay, so when you combine the fundamental news with the technicals, you see how easy it is to set up where you don't have to risk much and you can go after a nice profit. You just need to be disciplined. If you figure in the beginning, okay, I'm only going to risk $1 up to my stop loss to get above the resistance. If it breaks through, I'm out. You have to be disciplined that if it breaks through, you don't start sliding your stop loss. Oh, well, it broke through, but I want to stay with it. So you say, okay, I'll slide it up above this resistance. And then it keeps climbing and you say, oh, I don't want to get out of it. I'll slide it above the next resistance. And I think we've all done that at times. Okay. Then before you know it, you say, wow, I'm way overexposed more than I wanted to with this. And you start trying to double up and you get yourself in trouble. So part of the key to risk management is stick to your plan. If your plan was resistance level, and you say, okay, I'm going to trade down off the resistance because the fundamental news says that, and you take a trade size that's going to make a profit that you like, and that the risk is acceptable for the distance to your stop loss above the resistance, then stick to your plan. Okay? Stick to your plan. And in this case, it would have worked out very well. Very easy move with today's environment, that oil was going to cap itself eventually here pretty quick with the rise it was having, just because of what's going on with major economies all around the world shutting up shop for a while. Okay, and there was an oversupply of oil even before that. Before this pandemic, oil was having trouble staying up in price. So it's clear what's happening here. Now, question is, okay, here's a major support level. We go to 4-hour candles. Support, support, support. It's right down around $20 a barrel, just above, okay? The question is, do you trade up off the support when all the fundamental news is saying sell, right? The fundamental news is not good for oil prices, right? So to say, because there's a support level, technically speaking, I'm going to put a buy limit pending order, okay? You could program a buy limit pending order just above this support level. Here's the support, support. Right about there, you could say, okay, when it hits that price, my buy limit pending order will buy. And you could program your pending order to buy. The question is, how long do you stay with it if you're expecting a bounce off of there? Okay, so I have no problem setting up a buy limit off this support, because many times, even if it's against the fundamental news, there's at least a temporary bounce. So would I expect it to hit this support level and go running all the way back up to the resistance, up around 25 up here? Not unless the news changes. Not unless Russia and OPEC start to say, yeah, we are going to negotiate. We are maybe going to have a deal. Then, yeah, you'd get more than just a bounce off this support, right? So my take on this is you can take a shot, because technically speaking, if we're talking about technical analysis, that's a nice support level that's been there for quite some time. And you'll probably get some kind of bounce off that support, okay? So you could take a shot with the pending order here. My stop loss would be just below that support, if you're using a stop loss, just below the support, because what do you think happens if this support level breaks? What do you think will happen to that $20 barrier that's been holding the price at or around $20 here? Here, if this support level breaks on this move down, what do you think might happen? A small drop or a large drop if that support level breaks? In general, the longer the support level has been there without being broke, if it gets broke, it must have been really big news that made it break. And you tend to have a larger drop the more significant that support level is if it gets broken. So I would agree with a lot of what you all are saying. The potential is there for a very large drop if it breaks the $20 mark. That means, wow, there's really bad news if it breaks that support level. And you know, we can't, this is interesting to see. Let's go to 4-hour candles. Do we see the next support level on 4-hour candles? No. Let's go to 1-day candles. Do we see the next support level on 1-day candles? No. This is uncharted territory for a long, long, long time. This is the type of news that if it breaks this support level, there hasn't been news this bad for oil as far back as you can see on the 1-day candles. Okay? That means it's a pretty big deal if it breaks that support level. Let's go to 1-week candles. I still can't see, right? You still cannot see a support level. If it breaks $20, you don't see a support level all the way back to 2017, as far back as I can see on 1-week candles. Let's go to 1 month. Each candle is 1 month. And guess what? You still don't see a support level. If it breaks this support level here, $20, or I'm sorry, it's down here. It's only showing on this month's candle. If it breaks this support level, the support level is only there because it formed this month. We already broke the last year's worth of supports, okay? We broke the support from 2016 this month. That was a 4-year support level. It didn't break below 25 since 2016. And by the way, technically speaking, we just drew a line at 25, and that's where that resistance level was. Do you remember? Let's go back. 1-hour candles. Here's the resistance, right? Here's the resistance. Why did it choose to stop at 25? Resistance, resistance, drop. Of all places, why did it stop at 25? Let's go to those 1-month candles. Look here. That was the old support from 2016, the exact spot where yesterday's rally stopped climbing. Once a major support level is broken, it then typically becomes resistance if it tries to go back up. So this is the idea of taking an outside in look at the candles and an inside out look. Look at the small candles. We were looking at 1 hour candles and we saw a resistance level. We didn't know why that exact price was the resistance unless you take a bigger picture view too. And by looking at 1 month candles, we can see, that was a support level that was broken. It broke a 4-year support level that hadn't been broken for 4 years. And even back further, because it wasn't broken here, it wasn't broken here. So for a decade, over a decade back on the chart, we can see this price level was not broken. And that's the exact price when it tried to recover that it stopped climbing on the 1 hour candles, right there, as expected. Okay, so this is really bad news. It broke decades old support. Okay, now, but where do we find the next support level? We still don't see another one. What I have to do is shrink the candles with my magnifying glass, hit the minus, and now I see it. Okay, here I drew a line already. It's way back here. You see this, these are 1 month candles. This is back to the year 2000, 2001. Okay, at the turn of the century, literally. So the next support level is down around $17.50. And that hasn't been tested since the year 2000, 2001. Early 2001, end of 2000. So 20 years ago, we are in an area below, we just broke a support level that hadn't been broken for over 10 years. We're now between that broken support and the next support level that hasn't been touched for about 20 years. Okay, so this is quite big news. Okay, so let's go back then and we look at the current movement and we say, if this breaks, then if I put a pending order, let me get to where I can see some space. Again, I need to hit my minus. If I put a pending order below the current support, okay, if I do a pending order starting below the current support, now my lines will probably be out of place because I'm on 1 month candles, but it's the only way to get below the support is to go to 1 month candles and shrink them. Okay, so now let's go back to 1 hour. And yeah, as I suspected, I'll have to draw my lines here. So if we get below the current support, if it breaks below 20, that could be off and running for another $3 or so. 20.5 really is where the support is. At some point, it could burst below there and run another $3 down. And you say, well, that's not so much. Well, it is. If you take a position like a one lot, 1,000 barrels, that's $1,000 per dollar it drops. Can make a nice little scalp move there. So the next support level is at about 17.5 if it breaks the current support around 20. Okay, 20.5. So you could think about pending orders below that support. What kind of pending order sells from a lower point that you could prepare below the current support level? If I wanted to program it to sell from, I don't know, price of 19.5. Yeah, it's a sell stop. The sell stop is the pending order that sells from a lower point. So sure. Someone's asking me to go over the idea of support and resistance. So a support level is a price that the market tries to test on the way down, but it holds and the market bounces back up, like exactly what we're seeing here. It tested and bounced up. It tested the same price and bounced up. Okay, so that's a support level, the price level at which it's supporting the market and not letting it drop below. Resistance is the opposite. Price level that it hits and drops. It hits and drops. And you see repetitively near the same price, resistance, resistance, reversal. Okay, resistance, resistance, and it keeps reversing off the resistance. And if it breaks the resistance, then you tend to see a big run. Same with support. Support, back up. Support, back up. So the idea of a buy stop is if it hits the support, maybe it'll run back up. Or I mean a buy limit. A buy limit, you program it to buy. If it hits the support, boom, and it buys automatically. If it's wrong, you'd hit your stop loss just below the support, and you could trigger a sell with a sell stop. If it breaks the support, it likely could drop further. Okay, you could be wrong on both, by the way, but you're risking not so much to either side of the support or resistance if you set it up that way. Okay, so you could put yourself in a situation where, according to the fundamental news, there's a potential for a big run. And if I'm wrong, I'm only risking a little bit back to the other side of the support or resistance, depending what you're trading off of. Okay, I hope that clears things up, Al-Haji. Okay, any other questions, please feel free to ask. I think we spent enough time on oil. We're nearing this support level down here. I don't think we're there yet. You could think about if you wanted to take a trade for a bounce up off that support, if it gets down to maybe 20.5 or 21 flat, something like that. I wouldn't risk personally too much to the other side if it breaks the support, just because I know the fundamental news is working against oil rising right now. You also could set up both moves at the same time. Your buy limit with a little risk if it breaks, and your sell stop in case it breaks. It would trigger your sell. Okay, so what about gold? Gold has reached a resistance level. We can see that. It's pushed back up some because fear is kind of hitting the markets again. And so gold is stabilized at a high point. If you think the US will sign that deal today, the House will pass it, okay, the stimulus deal, if you think that might create some positive momentum on the markets and ease fear, maybe you say, okay, I have good reason to take a market sell now on gold, okay, and put my stop loss up above the resistance somewhere, far enough that you don't get hit by a little test of the resistance, okay. It's best maybe to have a distance that is beyond the wicks at the resistance, so that if it does that again, it doesn't trigger your stop loss before potentially dropping, okay. You could either do, if you believe gold will drop and you trust this resistance, or for you technical traders that don't care what the fundamental news is, you just trade off the price levels, you have two options if you wanted to sell here. You could either sell now, or you could do a pending order closer to the resistance. In case it comes back up, you could sell with a sell limit pending order from a price that you think is better. Okay, everyone has their own style, whether you're more patient, waiting for a perfect entry, or if you just say, nah, I think it could drop now, and you get in now. Either one's okay. Just put your trade size accordingly. If you get in where it is now and you sell and you want your stop loss up here, that's a longer distance. So maybe you take a smaller trade so that distance to a stop loss still only risks the same amount. If you're waiting and hoping that it comes closer to the resistance before you sell, then that's a shorter distance to your stop loss. And so then you could take a larger trade with the same size overall exposure. Okay, so it's a trade-off. You widen the strike zone, get in early, then maybe you take a smaller trade. You try and be more perfect, you risk missing the movement, but if you get in at a better price, you can risk less with the same trade size, or take a larger trade for larger potential profit with the same level of risk as getting in earlier with a smaller trade. So in any effect, if you like this resistance level, it looks like a nice resistance level. At some point, either now or when it gets close to the resistance, you could decide to sell and put a stop loss above the resistance. Okay, certainly you could be wrong. Gold could spike through, but it's a small risk, right? It's a measured risk with the idea that, hey, US is going to sign a stimulus package or vote it through in the House probably today. If that creates momentum with the markets, maybe gold pulls back down. And look at the potential for gold to drop. The next support level is here, which is a lot further away than the resistance level. Okay, so it's like a 3-to-1 potential profit to risk You only need to be right once out of 3 times to break even on that. If you're right even 50% of the time on those moves, you'll be making a nice profit. Okay, so taking the fundamentals that maybe in the short term, there's going to be some positive momentum later today if the US gets this bill passed. Maybe that helps gold maybe pull down a little. Okay, what else could you prepare in case the opposite happens? Because you don't have to guess the market. You can prepare for a pullback right now, even with a market move. What can you prepare in case it breaks through the resistance up here? In case the opposite happens. Yeah, buy stop. Exactly. You could have a market move down and a buy stop above the resistance in case the opposite happens. You don't have to be afraid to change directions. As soon as you recognize something went wrong, the resistance broke, in this example, you certainly could flip of a switch buy. Okay, and the way the markets have been running this past few weeks, there's been some huge runs as support levels or resistance levels get broke, or huge reversals as they're reached. So even if you're wrong on one and you're right on the other, you stand for a really large potential profit still. Okay, type okay if everyone's still with me, or questions. Okay, great. I periodically check with everyone just to make sure my mic is still running, because sometimes I go a while without any questions or anything popping up. Okay, so what about indices? We'll look at one index and you understand that they're all pretty much moving the same way. So we'll look at one, and the same story applies pretty much to all of them. Reacting to global fear, temporarily reacting anyways to positive stories like stimulus packages and such. And so, we can look at the Russell 2000. Up, 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 okay? Yesterday, back down today, okay? And if we wanted to look at the China 50, same thing, up yesterday, down today. It's a global reaction. S&P 500, up yesterday, down today. NASDAQ, same thing. It looks like the same asset. NASDAQ and S&P 500 look exactly the same. Okay. Now, there was some fundamental news that we looked at that was positive today. And that happened somewhere in this drop and created a little bit of a rise when those positive numbers came out of the US, temporary momentum, and then look what happened. Boom, straight down. Okay. Where's the next support level on the S&P 500? Well, maybe right about here. Okay, this was an old resistance, breakthrough, resistance, back up, breakthrough candle. So this looks like in the short term, it could still be quite a rapid drop before it hits the next support level. Okay, could have some small pullbacks or large ones, but the next support level, as I see it, is somewhere down here. And the same is true if we look at the NASDAQ. Okay, support level is down a ways. Still has room to run before it hits any major support. Momentum is down. Keep in mind what could happen if an article passes. If a breaking news story comes that, hey, the House of Representatives passed this package, the stimulus package, you could see if only temporary, you could see a pullback the other direction. Yeah, of course, Alhaji. The reason we're looking at indices and oil and gold, these assets right now, is because of the much larger potential for reacting to global stories that are occurring. Individual Forex, we can use the same concepts, but they're more regional. They're more regional assets. Okay, so you would be paying attention to local stories, but right now, everything is being driven more by the global stories. So we're looking at global type assets. Okay. And so this certainly has potential to keep dropping. With the news that could come later today, there's potential for some bounces. Okay. So pay attention if there's any new articles coming out, but there's huge potential for movement here on these indices as well. I think this is a good place to stop. Any questions before we end things? Okay, great. Listen, everybody, as you go into any trading the rest of the day today, two things to keep in mind. Watch for volatility, so be careful with your trade sizes, okay? And secondly, you have to think about whether you want pending orders or opened trades to run through the weekend. Because keep in mind, there's a huge possibility for gapping between the close price Friday, which is today, and the open Sunday night / Monday morning. Prices can open with huge gaps with the type of storylines that are occurring right now. So you may think about whether you should maybe close trades before the weekend and reopen after, unless you're trying to predict the direction that the gap might occur. If it works in your favor, great. But understand that if you have a stop loss on something and it gaps from Friday's close to Sunday's open, if it gaps past your stop loss, you'll lose further than you intended then. You'll get the price that it gaps to, and you'll lose past your stop loss potentially. Now, same thing, you know, it could gap in your favor as well, and you might make a nice profit, but you have to consider the risk of carrying trades through the weekend. All right, especially with the indices, gold, oil, these movers, these assets have been major movers and have had large gaps through weekends recently. So keep that in mind. Pending orders also, you can get messed up on gaps. If I've got, let's say, a pending order on oil to buy off that support level, a buy limit, okay, and it doesn't open yet, and then through the weekend, there's bad news for oil, let's say, and oil opens at, I don't know, $15 a barrel or something. And I had a buy limit to buy off the support at 20, and it gapped past. My entry would be at 20, where I had my buy limit, because limit entries are guaranteed. But you'd open in this huge negative, because if it gapped past your entry, you'd start out in a big negative. So just keep in mind, there's risk in carrying these trades right now with all this volatility through the weekends. Okay. Paul, I can't advise you whether to short NASDAQ before the close. If you feel that there's more and more bad news going to be through the weekend, if you open a sell on NASDAQ before the close and it opens Sunday at a huge gap down, wow, you're in a huge profit, right? If you already opened that sell position before the market closes. But you're running the risk. You open that sell position before the market closes and there's good news through the weekend and it gaps up hundreds or thousands of points, you're going to open huge negative. You would open at a price way in the negative. So that's a risk you have to consider for yourself. I definitely can't tell you whether you should do that or not. Okay. All right. Thanks everybody for joining. Good luck with your trading. Be careful with your exposures. Okay. Bye for now. Thanks, Dave. I appreciate it. Peter, thank you. All right. Bye, everybody.